Good afternoon, and welcome to another of Sawtooth Solutions' ongoing series of educational webinars. My name is Scott Grayson, and I'm Vice President of Sawtooth Solutions. As most of you know, our firm is a turnkey asset management platform with over $20 billion in assets under management and advisement. Our platform empowers advisors to provide unified managed account solutions addressing a myriad of client situations. These solutions can be customized with enhanced tax management, sustainable investment screens, annuity-based longevity solutions, and/or direct index. Rest assured that all the third-party investment solutions available on our platform have been reviewed and curated by our investment research and due diligence team. Now, before I introduce today's guest, there are a few housekeeping items. First, today's presentation is intended for advisor use only. Second, if you have any questions, please use the chat box to type in those, and we'll get to as many as we can at the end of the presentation. Finally, there's no need to take notes. Today's webinar is being recorded, and you'll be receiving an email with a link to that recording within 24 hours. Today's webinar is presented by SouthernSun Asset Management, led by founder, CEO, and CIO, Michael Cook. Their investment team is composed of seasoned analysts with complementary industry and financial services backgrounds. They creatively source ideas through break room to boardroom due diligence and by maintaining a global perspective. The firm relies on proprietary, bottom-up, on-site research to identify attractively valued companies that have niche dominance, financial flexibility, and proven management teams. They believe that human capital and financial strength are of equal importance and, when coupled with niche dominance, can create unique long-term buying opportunities. Now, it's my pleasure to introduce Philip Cook, principal at SouthernSun Asset Management. Mr. Cook joined SouthernSun in 2006. He's responsible for the coordination of research and communication within the investment team and is responsible for the research and analysis of existing portfolio companies as well as new ideas. He also provides input on portfolio management and construction. Prior to joining SouthernSun, Mr. Cook served as the analyst to the chairman and CEO of Trivest Partners, which is a Miami-based private equity firm focused on middle market LBOs. He received his BS in international business, summa cum laude, from Auburn University. Mr. Cook also serves on the board of Sukasa Family Ministries. With that, I'll turn things over to you, Philip.
All right, thanks, Scott. I appreciate it. And thank you all for your time today and appreciate the interest in SouthernSun. I am going to share my screen real quick so that we can be looking at the same presentation. All right, coming through on your end, Scott?
Yes, it is.
Good deal. All right, so just thank you for that introduction. Just a little bit more about our firm. We are based in Memphis and are 100% employee owned. We've been focused on small and mid cap U.S. companies for 32 years now. As Scott mentioned, my father founded our firm 32 years ago. I've been with the firm for 15 years and serve as the co-CIO and also a member of the management team. There's 4 of us on the management team. So in a nutshell, we are building and managing a concentrated portfolio of best ideas. We spend a lot of time doing our own homework. We spend a lot of time traveling, working our networks through trade shows and sort of unconventional industry-focused venues and activities. And that allows us to find ideas that are sort of out of the noise. It helps that we're in Memphis, so we're not in the noise to begin with, but we do our own work and we are long-term business owners. We really like to get into the mind of being an owner of businesses. And as Scott mentioned, I worked in private equity prior to coming to SouthernSun. And as you'll see, there's a lot of similarities in the private equity approach to owning a business and the way that SouthernSun goes about finding new ideas and managing a portfolio. So with that, I will launch into really something that we've been kicking around a lot as a team this past 12 months, really 15 months now. As I mentioned, we've been together as a team for quite a number of years. Our team has been through the GFC and the subsequent bull market. Our team has been together through the industrial recession and the trade war with China and the collapse in the market in the fourth quarter of 2018 and the subsequent rise in the market in 2019 and then the pandemic again last year. And so what we're looking at when we think about over 30 years of investing is what can we learn about the past and how can that prepare us for the future. And I think the way that we approach those learnings is valuable for you guys as well as you're thinking about manager selection. And that was really something that I thought might be of interest. And again, looking forward to some questions at the end. I'm not great at just straight presentation, so I'll do my best to go through this in a timely manner and allow an opportunity for questions. So the first thing that I think is important in sort of setting the stage is studying the history. We spend a lot of time studying history when we're looking at companies because we might remind ourselves very frequently that we can't study the future. We look at the future, we think about the future, we try to model the future when we're looking at valuation. But one thing we know about it is that it's not going to be accurate. Our guesses are going to be the best guesses we can, but they're not going to be fully accurate. What we can see is truth is in the past. And so we go back to the past and we rely on the past to inform our future. And when we think about the past in our world of small cap investing, what you see here is consistent pattern that right out of the gates, when there is a recession, small cap stocks suffer the most. I'm not telling you guys anything you don't already know. We're really just kind of setting the stage. But small cap stocks are always going to underperform when we come out of the gates in a recession. But as you would suspect, what you see subsequent to that painful beginning is a reversal of fortunes. And what you see is small cap stocks really starting to outperform. You get that initial hit. And I think everybody looks at that and says, yeah, everybody knows that small caps take that hit and then boom, they take off. But I think what is sometimes less well understood, or at least not focused on as much, in part because most of the market is made up of short-term investors, people aren't thinking about, okay, but what happens not in the first year out of the recession, but what happens in year 2, 3, 4, 5, 6? And what you see is a continued outperformance of small cap companies, not just in those initial quarters, but in the years subsequent to that. And I think as you think about where we are today, we're following the same path that we've been on. Small caps underperformed last year, and what have they done the past 12 months? Really taken off. But what we believe is true from history and have no reason to believe based on the fundamentals we see today is that history should play out over the coming years, not quarters. And there's a lot of gas left in the tank for small caps relative to large caps. Then we have a unique dynamic going on in this recession. And that is, as you can see, this slide shows you 10-year annualized rolling returns for U.S. small cap value stocks, or U.S. small cap stock, U.S. value stocks, excuse me. So the first slide was small cap. This is about value versus growth. 10-year annualized rolling returns going back to 1926. Is that right? Yeah, 1936. This is the first recession we've had where we have 10-year rolling returns that favor growth over value consistently for years and years and years. And there's a lot of good reasons for that. There's a lot of reasons that make sense at this moment in time with the explosion of technology that's taken place over the last 25 years. There's a lot of good reasons for growth beating value. But I also think that that doesn't necessarily mean value is irrelevant going forward. And I also, in that same vein, I don't think that all of history, the last 100 years, is irrelevant. And if you think about the last 100 years and you look at the 10-year annualized rolling returns, value consistently beats growth. And we believe that there's at least some questions or some reason to believe that the pandemic, along with some other forces, including this long stretch of growth outperforming value, could be a reason for a reset. Again, that's just something sort of food for thought for you guys as you think about manager selection. As we'll get into, it doesn't have a whole lot to do with how we pick stocks. We're benchmark agnostic. We're absolute return focused. We own a small number of businesses. And so we're looking for unique stories where there's a restructuring going on or there's under-recognized value. We found a company that has 1 or 2 sell-side analysts that cover it, and they're just being ignored by the market. Those are the sorts of companies we're looking for. And so we don't necessarily care whether value or growth outperforms the next 10 years. I think value outperforming is an extra tailwind, but we're confident that we can achieve our 12 to 15% returns, irrespective of the value versus growth thing. But as you guys think about picking managers, I do think it's relevant to think about history in light of, or the future in light of history. So why small cap and mid caps excel? This is sort of a philosophical question. We have seen large caps perform exceptionally, really not large caps, but mega caps perform exceptionally well, not just for the past few years, but for the past decade. And in particular, that has sort of accelerated since 2016. Keep in mind that in 2015, we entered an industrial recession that did not coincide with an economic recession. That's the first time we've had an industrial recession without an economic recession in something like 35, 40 years. Normally they go hand in hand. And so for a lot of industrial type companies, which we own, 2015-16 was a tough time. And then you had the Trump era trade war with China come with heavy tariffs, which again, really put a crosshair on industrial type businesses. So a lot of small caps, a lot of component suppliers for larger businesses really hurt during this last 5-year stretch where mega caps have just absolutely exploded. But when we come into a crisis moment like the pandemic, what we love about small caps and always have loved about small caps is how nimble they are. So watching a management team have a plan and execute that plan, and then watching teams on larger cap companies, very, very smart managers. But when they set their plan in place, it takes time for that plan to actually filter through the organization. Whereas with our market cap where we're playing, you see the management teams really be able to execute and execute quickly. So we love that sort of adaptive, nimble nature of smaller cap companies. And then what that leads to, and what we're seeing just starting now as the vaccine is rolling out, is we're seeing above average operating leverage for these smaller, more nimble businesses than you see for their larger peers. And I think that that's something to watch as, again, as we're just sort of rolling. This is the first quarter. So earnings season is just starting here in the next week. And this is the first quarter where we've had the vaccine in place to any degree. So last earnings season back in April and May was reporting on first quarter results. You have winter weather to deal with. You have a lot of places still on lockdown, not just in the US, but Europe and elsewhere. And then things start unthawing here in the second quarter. So watch as we go into this quarter, but even more as we go into the back half of the year, watch small companies versus large companies. I think there's a lot to like about the smaller companies and how they've got operating leverage. And again, going back to that slide I showed earlier, it's not a 1 or 2 quarter phenomenon. Consistently over history, it's been a multi-year phenomenon that small caps enjoy that benefit. So one of the things that is less about the fundamentals of the company and more about how the market views the companies is the valuations. And right now, the safest place typically is those mega caps. That's where people have gone when they get concerned about various macro topics. That provides some compelling valuations in the small cap space. That said, if you look at the valuation metrics right now, if you look at the Russell 2000, it's not trading at attractive multiples. And that is precisely because all small caps and mid caps are not the same. We're now in the part of the cycle where you've got to have a manager who really understands the underlying businesses. Throwing darts has worked. Everybody has benefited from this massive rebound from the depths of the pandemic. Over the next 12 to 36 months, you will feel very confident you will start to see winners and losers. You'll start to see managers who really position themselves in a unique fashion by finding the best businesses versus finding the averages businesses. Everybody's done well recently, and that will not continue. And I think, again, I'm not telling you anything you don't know. You guys know that over time, there's a separation of the average and the great. And those exceptional managers, just like for me, those exceptional companies really start to separate themselves. So we're excited and sort of on edge as we start to see these next few quarters of earnings, because I feel very confident that you will start to really see an appreciation for the highest quality businesses, and not sort of putting everybody in the same bucket of everybody's rebounding, everybody's doing well. So financial flexibility and really organic growth are something that we're looking at with a close eye. And the reason why the financial flexibility is so key is that the market came into this particular recession, this particular crisis, at all-time highs of leverage. And if you look at the Russell 2000 right now, it's trading at leverage ratios that you would typically not see at this point in the cycle. If you look at our portfolio, we're trading at half the leverage ratio of our index, the Russell 2000, the Russell 2500. So we look at our portfolio as having significant financial flexibility. And I think that's what you guys need to look for as well with your managers, is looking through to the portfolio and seeing, do the companies in that portfolio have any flexibility left? Because the ones that have the flexibility are going to be able to invest in R&D, CapEx expansion, M&A activity, so both organic and inorganic growth. And those who don't have the financial flexibility, which again, there's an all-time high number of companies that are really strapped for cash. And so what does their next 12 to 24 months look like? It looks like paying down debt. So looking at those financial flexibility metrics are really important as you look at your managers and think about what their underlying businesses are going to be able to do with their cash the next couple years. And the ones that are going to show organic growth are going to be the ones that really can reinvest. Everybody's benefiting from the rebound, but those who have the flexibility to reinvest in their businesses and have the gas pedal down are going to show multiple years of organic growth that outpaces their peers. And that's where you're going to see that real significant stock price performance that's going to separate the best managers from the average managers. So I've sort of gone through this. Scott actually mentioned some of this in the intro, but these are core characteristics that, again, I think are very important. And the one that I'll highlight here is management adaptability. Scott referenced how important the human capital component is to our process. If you looked at this slide 20 years ago, it looked the exact same. We haven't changed how we go. We've gotten better at how we invest. We've learned from our mistakes and our successes. but the core of what we're looking for has remained constant. And I think that's important for managers, particularly in a world right now where you have managers who have portfolio management teams that have not been through crises together. So inexperience at the manager level is going to produce, again, all of them have done well coming out of the initial throes of the recession, but what decisions they've been making the last 12 months are going to define how well we and others do the next 3 to 5 years. Experience matters. The same is true at the management team level of a portfolio company. There are a lot of CEOs and CFOs who've never been through a recession. The last real crisis in this country was 2008. And a lot of those guys were, those ladies and those gentlemen were vice presidents within an operating organization. And now they're at the top. They're making decisions. They're allocating capital. They're deciding whether to go at M&A or invest in R&D. And this is their first go round. And again, they came in on average with above normal levels of leverage. That creates an issue. And so management adaptability, having management teams who've been through crises before, have a track record of being adaptable to the environment that we're in. And as you talk about inflation, I'll talk about that real quickly before I finish up. That's something that a lot of these CEOs and CFOs haven't had to do before. How do they handle the cost inflation? How do they go out and price? How do they think about customer relationships? What's more important, your customer relationship or holding your margin by increasing your price? Do you give up market share and hang on to price? Or do you gain market share and lose price and margin? Those are things that if you don't have experienced management teams, you will see over the next 12 to 36 months, a separation between those who are really, really exceptional and those who are average. And I think our experience in 30 something years of being deeply involved with management teams, understanding the value of people in a technology driven world, there's still a lot of people making decisions. And we spend a lot of time with those people. So I'm wrapping up here. These are a lot of things that I've already mentioned, but thinking about how to choose the right manager, a lot of it, again, it plays well into how we think about choosing the right business to invest in. But long run valuations are driven by these management teams and their ability to deliver strong cash flows, earning growth, organic top line growth, high returns on invested capital. A lot of those things are going to be the defining characteristics of what produces higher stock prices and above average shareholder returns the next 3 to 5 years. And then as you think about manager selection, the impact on inflation is really critical. Inflation hurts some industries, and with inflation comes higher interest rates, or can lead to higher interest rates. In most cases does. So again, those highly levered companies, as you see interest rates tick up, that really, really restricts their ability to participate in M&A and go out and invest in their own business through R&D and CapEx. So we love to see a manager who's got a flexible balance sheet. We love to see a portfolio of companies that's positioned well from a balance sheet standpoint to go out and invest. So not just survive the pandemic, but really thrive in the quarters that come out of the pandemic. And then as we think about this active versus passive, the great thing about active management is that we can pay attention to these new dynamics. What's going on right now has never happened before. And the machines have to rely on information that has been inputted from previous experiences. So there's always this reactive nature to passive investing. And that's one of the beauties. Passive investing has worked well in a low volatility environment in 2008 11, 12, 13, 14, so forth. But now that volatility has come back, I really love active management as an opportunity to, again, you got to find the right manager with the right experience level and track record, but the ability to see the dynamics in the market and be proactive instead of being reactive as the passive funds are, I think is a real benefit and could be a big winner for the next few years. So that's the end of my prepared section. I get excited about this stuff and could talk about it for a long time. I hope that wasn't too long-winded, but would love the opportunity to answer some questions.
Well, thanks, Philip. We had several questions come in. I'm going to maybe meld a couple of them together here. And one of them you kind of set up for yourself. Some of the viewers are mentioning the fact that there's some forecasts of additional volatility in the markets. We've had a long bull run. The nice thing about bull runs is while you can have some volatility, it typically is on the upside. We don't get much complaint from our clients when we have that upside volatility.
Right.
Also, a lot of discussion in the industry and the folks on TV talking about the reintroduction of inflation into the picture. You talked about how that might impact the companies you're looking at and your evaluations of them, how they react to that. Are they prepared? For you as a firm, does that change the way that you do your process? How's that changed over the 32 years your firm's been around and through the different market cycles?
Yeah, that's a really good question, and like you mentioned, it's very timely given the market dynamics and the commentary very broadly about inflation and where it could be headed. First, on that point, having spoken with multiple dozen of CEOs and CFOs in the last month or two, I've been in facilities. I've traveled, I don't know, 6 of the last 8 weeks visiting companies, going and visiting facilities. I know a lot of people are still on lockdown, but we have great relationships with companies. So facilities are still operating. We've been the first visitor for just about every company we've met with, in-person visitor, but they are opening the doors and we have been able to get out there, and the inflation's real. I mean, I'm not a macroeconomist, so I don't know what that means. And I'm also not a prognosticator, so I don't know how long it lasts, but it is real. And there are plenty of fundamental, on the ground, not just anecdotal, but real hard evidence that the inflation is fairly broad spread across multiple sectors and industries. And I expect that will continue for some period of time. And what that has helped us to zero in on, Scott, as you sort of summed it up, was over our 30 plus years, having a niche, we call it niche dominance, but there aren't that many great companies out there. There just aren't. And there can only be one market share leader in every market, sort of by definition. You have some markets where you've got 2 or 3 players that sit at the top, but there's going to be 30 companies in an industry, but there's only 1 or 2 at the top. And the ones that really dominate a niche market have pricing power. Pricing power doesn't matter much when everything's just kind of going well, when inflation is low. But when inflation starts to come back and pushes up the cost base, the ones that have pricing power can actually seize that moment to raise prices, hold those prices, and not only offset the inflation on the cost base that they're seeing in the short run, but they can hang on to those prices after the cost inflation comes back down to earth. And what does that mean? Higher margins. And so what we see with these best-in-class companies is that every business cycle, their average margin just keeps ticking up. And that does not happen with the average company. If you pick an industry, we don't even own I was just reading about food distribution. We don't own a food distributor, but the margins on food distribution are razor thin. And every business cycle for every period that I studied going back 30, 40 years was razor thin margins for food distributors. That's where they live. if you can find best-in-class niche market or best-in-class companies in niche markets that have attractive dynamics where that pricing power exists, man, I tell you, the conversations we're having with CEOs right now is one of elation, because they've been waiting for inflation for so long, because it's really hard to go to your customers and say, we're raising prices 10% when you don't have a good reason for it. But right now, their customers know the inflation pressures they're feeling. They know that material costs are going up. They know that labor costs are going up. And so when they come and say, we're going to have to raise prices, the customers say, I get it. You can't do that if you're just an average company. It's really hard to get it, and it's really hard to hang on to it. And so I think that is a unique dynamic that's really helped us to zero in on that niche dominance piece.
That's great. Got another question here. Just thinking of my own experience over the last, several years, we've had this long bull market. It seems like a semi-annual event over the last 5 years, people questioning whether or not, we're at the top of the market, and, when's it going to roll off, and, when we're going to have a recession. I think 5 years ago, if you told somebody there's going to be a pandemic, then like, well, surely that would cause it. We've all seen a tremendous rebound in the market coming out of that pandemic slump. Now we're asking that question again. Our valuation stretched. Could this be the top? What are your views on that?
That is, man, that's the more than $1 million question. That is a question that I know that I don't have any unique insight into, and you guys probably know more than I do about where market cycles could be. But I will say this: volatility is here. We saw significant volatility in the fourth quarter of 2018 when the market went down 20+% in a very short period of time. And what happened in 2019? Right back up. And then the pandemic hits, right back down. What happens after the pandemic? Right back up. So when I think about that, and I think about disruptive technology, I think about the length of the bull market that existed since the GFC coming out of 2009, it doesn't seem like a stretch to me that after going straight up, there's another down. That said, if you kept your money invested through these ups and downs, especially if you had the right managers, you did better than trying to guess when, because these ups and downs have been quicker in their duration. So when things started going south in the fourth quarter of 18, or things started going south in the first quarter of last year, if you're trying to make quick rotations there, I mean, the market went straight back up after a few weeks. And so to the extent that we look at the market now and think, is there reason to be another pullback? Yes, there is. But I'd caution against necessarily believing that means we're in it for multiple years. I think it's probably more of a market phenomenon, because I do believe under the surface, there's a lot of pent-up demand. There's a lot of the global consumer is healthy, and interest rates are broadly low. So even if they do come back, even if there's inflation, I don't see a scenario where inflation gets out of control and interest rates go to, where they were in the 80s. Nothing looks like that. So interest rates, even if they tick back up, they're going to be at, relatively speaking, all-time low areas. And that's a really good spot for business. It's a good spot for the consumer. It's a good spot for people buying homes and all of that. So we feel very bullish, especially about the US economy. That said, if you look at the high-level metrics on the Russell 2000, you've got very high levels of debt relative to history, and you've got earnings yields that are very low right now. So very high earnings multiples, very high free cash flow multiples. And then on top of that, you've got pretty low returns on investment. So the dollars that companies are making and they're investing back into their business have not been generating much of a return. Again, broadly speaking, I don't have the numbers here to share with you, but go look at the return on capital, or we can send it to you afterwards. Go look at the return on equity, return on assets for the benchmark. They're very low right now. That's not a great recipe for success if you're just spitballing and hoping that if you throw a dart, you're going to hit a winner. And then on top of that, you've got something like 40% of the Russell 2000 has negative earnings right now. So that's a very high number of companies that are not generating cash, not trading at attractive multiples, and have high levels of debt. Not a great cocktail. That said, what speaks to us most loudly when we're thinking about the market is, can we find new ideas? When we were sitting here in 2016, 2017, 2018, first part of 20, we were having a hard time finding some new ideas. And that tells us the market multiples are getting high. And we saw a huge correction in the second half of 2018. Right now, we're still finding new ideas. And I think that speaks to this uneven recovery that we've had. Yes, the market is shot up, but not every company. And so there is opportunity out there, which gives me a lot of confidence that we're not at sort of across the board peak multiples. There's still opportunities to invest. Again, I think you got to do better than just spitballing. I think you got to be more thoughtful about where you're placing the capital. Large caps are stretched in places. I know small caps best, and there are subsets of small cap companies that are very attractive right now. So I think that bodes well for the next few years.
So the last question, and I'm going to go ahead and throw this one in. It's almost like these questions have kind of had a theme to them. Looking at the reference this point in the cycle, so I guess we're looking at the reintroduction of inflation. We've got increasing volatility. We've got, this point we are in the rebound out of the pandemic. The question is here, how important is financial flexibility in the context of all of this current environment?
Yeah, I mean, like I said, I think that that is of the utmost importance. When you look at the market right now, trading at relatively high multiples, you think about inflation, you think about interest rates ticking up with inflation, all-time high levels of debt don't mix well with rising interest rates and inflation. And so again, when you're looking at your managers, looking through the portfolio characteristics, looking at those statistics and saying, where does this portfolio stack up from a financial flexibility standpoint? Do they have higher levels of debt on average? That makes me nervous in this current environment for a lot of reasons. If there happens to be a surprise double dip sort of recession, then that lack of financial flexibility is incredibly dangerous. If it's just a continued positive fundamental growth market, it might not be dangerous, but with interest rates ticking up, it really ties a company's hands from being able to invest in their business and go out and participate in M&A. So I think more than ever, financial flexibility is huge. And I think that if you look at the benchmark, so if you're just saying, I'm just gonna pick small caps and I'm just gonna go with the Russell 2000, there's not a lot of financial flexibility in the Russell 2000 index if you're picking an index fund. But I do think you can find managers out there, whether it's us or somebody else, there are managers that understand the importance of financial flexibility right now. And those managers are going to have portfolios at levels of leverage much lower than the index. And I think that's important for advisors to be looking for when they're thinking about what managers to select.
Terrific. Well, that's the last of our questions. Thank you again, Philip. The small cap space is a fascinating area, interesting sandbox you play around in. and I'm sure everybody appreciates your comments as much as I did. Just a few closing comments here. I'm sure everyone would like to know more about your firm, and you can go to their SouthernSun website, southernsunam.com. Or if you've already signed up to partner with Sawtooth Solutions, you can find information about the strategies and models available on our platform in the Research Center contained inside the Spark Advisor Portal. I want to remind everyone that we're going to be forwarding a link to this presentation within 24 hours. So if you missed any portion of it, you're going to have an opportunity to watch those from that recorded webinar. Finally, I want to thank each of you for joining us for this presentation. We know that your time is valuable, and we sincerely appreciate that you chose to spend a good portion of this last hour with us. Hopefully, we'll find a way to partner together to deliver some exceptional client solutions. I hope we all make it a great day. Thank you.